This week, the market experienced a small correction with the S&P down over 1% and NASDAQ down over 2%. Brick-and-mortar retailers are one of the biggest losers in the retail landscape and within the investment community. Target reported this week, terrible numbers all around. Macy's, once an iconic department store company, how the world has changed. So what did Powell say today at Jackson Hole? Powell gave a lukewarm, tentative indication of possible interest rate cuts. He really said nothing. The only reason why I even pay any attention to this theater is only because so many people care, and it does move markets, but not for long. Hi, this is Steve Eisman, and welcome to another edition of the Weekly Wrap. This is for the week ending August 22, 2025. Before we start, I'm going to describe my process for creating this weekly because I've gotten a lot of comments about it. So I start preparing the weekly as early as Monday morning. There's always news of some sort, and sometimes there are earnings results on Monday as well. So I go through it all. I start writing up the weekly on Monday and continue to do so literally every day of the week. By Friday, I have something of a script as well as statistics and tables. Every word I say on the weekly is created by me. I don't have any assistants helping me. That's why when I do the weekly, I sometimes look like I'm staring at a teleprompter. That's because I sometimes am. I've tested just speaking from an outline, but it didn't work for me because I'm trying to convey a great deal of information. And with just an outline, I found that I missed conveying much of what I wanted to. So at times, I'm looking at a text or numbers on a screen, and sometimes not. And that's how I do it. And so now, back to the wrap. First, the stats. Last week, the market reached an all-time high with both the S&P 500 and NASDAQ up double digits for the year. This week, through Thursday, the market experienced a small correction with the S&P down over 1% and NASDAQ down over 2%. The decline, again, only through Thursday, was triggered by a decline in the tech and high-flying tech sectors. For example, at one point this week, Palantir was down 20% from its high. Of course, the stock is still up over 100% this year. So you might ask, what triggered this sell-off? I have no idea. Trading events like this happen all the time in high-flying stocks, and somebody starts selling, and then it feeds on itself. There was literally no fundamental news that I can see. But on Friday, the market had a big rally because of Fed Chairman Powell's speech at Jackson Hole, and more on that in a bit. Because of Friday's rally, the S&P closed roughly flat on the week, and NASDAQ was down less than 1%. It's another slow week in earnings, so I'll flag a few later. But first, I'd like to flag a few things I've been thinking about. First up, you always hear things from commentators like, quote, sell in May and go away, or August is always a quiet month. And I just don't understand why people keep repeating that stuff. I don't think it's true. Why would it be true? Is there something about May and August that makes those months unique? Does the news cycle stop during the summer? I don't think so. Let's just look at this year. If you sold on May 30th, the S&P 500 was at 5,888.55, and NASDAQ was at 19,113.77. As of Friday of last week, the S&P is up 9.5% versus May 30th, and NASDAQ is up 13%. So if you're a long-term investor and did nothing, you are sitting pretty. As for August, yes, sometimes August is quiet and sometimes not, just like every other month of the year. I remember that in August 1998, admittedly that was a while ago, the hedge fund long-term capital blew up and the stock market swooned. August was wild that year. So some of these so-called rules are just plain silly. I would just ignore them. Other things I'm thinking about. Who cares about retail? And I don't mean retail investors, I mean retail stocks. Now, you've heard me discuss at length the strength of the US stock market driven by the tech sector and tech-adjacent sectors. But what I haven't dwelt on until now is the losing sectors out there, because after all, those stocks offer little investment opportunity on the long side. Brick-and-mortar retailers are one of the biggest losers in the retail landscape and within the investment community. Prior to Amazon and social media changing the retail landscape, people made careers, both sell-side and buy-side analysts, analyzing traditional retailers. Analysts used to walk the malls on Friday and weekends all day, up and down the aisles, counting customers, studying the volume of merchandise, talking to the store managers and salespeople, and calculating markdowns. Everyone was looking for an edge for the Monday morning meetings. Weekly sales data was parsed and analyzed like tea leaves or like the Bible. Studying same-store sales growth or declines was like a religion. Roll-ups, roll-outs, new concepts, old concepts, urban department stores, and suburban malls. It was all relevant during the 1990s. Specialty retailers and heritage department stores fought each other for market share, and mall REITs were really good businesses. Those were the days of the Limited, Victoria's Secret, and Bed Bath & Beyond, and independent department stores like Barney's and Lord & Taylor. Les Wexner's empire was cocktail conversation for years, and retail analysts held their collective breaths from Thanksgiving to Christmas. Black Friday was spent estimating holiday sales. And since a very, very high percentage of annual retail sales happened during that period, a mere fluke of the calendar could shrink the number of shopping days and destroy same-store comps. Early online shopping was dismissed as a sideshow, and influencers selling merchandise on Instagram and TikTok could not even be imagined. Black Friday ruled, and Cyber Monday didn't exist. Well, the world sure has changed. Just take a look at these market caps. Amazon, $2.4 trillion. Walmart, $810 billion. Costco, $434 billion. Target, or as we used to call it, Target, a stock investors really used to care about a lot, only $45 billion. Its market cap used to be literally 3 times higher. And by the way, Target reported this week, terrible numbers all around, and it announced a new CEO who was an insider, which was a disappointment to the street, and the stock was down 6% on Wednesday. Estee Lauder, the makeup company. The company has a market cap of $31 billion, but it was once 4 times higher. They reported weak numbers this week with sales down in the quarter 12%. Investors are hoping for a turnaround, but that takes time. It's early. And lastly, Macy's, once an iconic department store company, now has a market cap of only $3.5 billion. Sum it up. Today's investors just don't focus on traditional retail because I just explained, most retailers just don't matter that much anymore. Other than Amazon and Walmart, Costco is important, and so are Home Depot and Lowe's. And there are some others as well. But the list has gotten much, much smaller. Department stores are fighting for their lives buried under debt, and the luxury market has its own ecosystem dominated by a few multinationals like LVMH. And China has learned not to just make iPhones and EV cars, but also to make cheap knockoffs of designer clothes to fuel the insatiable appetite for shopping. How the world has changed. Moving on. The Fed. This week is Jackson Hole, and every day, at least a few people were on CNBC or Bloomberg and pontificated about what Chairman Powell would say. Will he be dovish or bearish? What are the implications of either? Would he respond to President Trump's criticisms in any way? Every word he utters will be analyzed to death. It will be treated as if Moses is coming down from Sinai with the 10 Commandments. Are there still 10? In the 1990s, people seriously would examine how thick Alan Greenspan's briefcase was, as if that was some kind of indication of anything. It's all pretty ridiculous in my view. Take a step back. Suppose Powell comes off a bit hawkish, so maybe the market sells off a bit. But if the economy weakens, he'll change his tune. The Fed has always been data dependent, and we can all read the data as well as the Fed. The monthly pronouncements by the Fed are just not that important. The only time they are important is if it becomes clear that the Fed is going to be very aggressive in raising or lowering rates. Anything else, like what's going on now, is just tinkering. Remember during the financial crisis, Jim Cramer got on CNBC and was begging the Fed to cut rates, and he was screaming that they know nothing. He missed the point. It was not about rates. It was about the financial system. And you can't save the system just by lowering rates. The only reason why I even pay any attention to this theater is only because so many people care. and it does move markets, but not for long. So what did Powell say today at Jackson Hole? Well, in my view, he really did not say anything, but he said nothing masterfully. Saying nothing masterfully is an art, by the way. Powell gave a lukewarm, tentative indication of possible interest rate cuts. I'll say that again. Powell gave a lukewarm, tentative indication of possible interest rate cuts. But he also noted a high level of uncertainty because of the impact of tariffs. Here's the big quote that everybody's focused on. Quote, with policy in restrictive territory, the baseline outlook and the shifting balances may warrant adjusting our policy stance. May warrant. In other words, we will probably cut rates, but if the data goes the wrong way, we won't. Like I said, he really said nothing, but the market loved it and rallied hard, and the 10-year Treasury yield went down as well, which of course caused a nice rally in housing-related stocks. Now let's turn just to a couple of earnings reports. Home Depot. Total sales growth was 5%. Earnings per share growth was negative 1%. The company missed consensus revenue and earnings per share, but the stock was up. Why? Well, Home Depot is definitely a great company, but the last few years have been tough. COVID was great for the company, and people stayed home and fixed their homes. So in 2021, earnings per share growth was positive 17%. And in 2022, it was plus 29%. This was a big pull forward of demand, and so EPS growth slowed to 7% in 2023 and negative 9% in 2024, and the consensus for 2025 is for down 1%. And despite the earnings miss, and here's the key, Home Depot reaffirmed 2025 guidance. Although guidance, frankly, is hardly impressive. Total sales growth of 3% and earnings per share to decline 2%, whereas the consensus is for down 1%. Home Depot suffers, in my view, from what ails the existing housing market. Moribund sales of existing homes, because existing homeowners all refinanced during COVID at 3 to 4%, but today's mortgage rate is 6.5%. So buyers can't afford to buy, and sellers would have to sell at a price way down to move the market, which they won't do as long as they have jobs. This is all a side effect of the Fed cutting rates to zero during COVID, which everyone cheered back then, but now we are living with the after effects, which include vastly declining mobility, which is not a good thing. There is no free lunch. Home Depot needs lower long-term rates for existing home sales to pick up, and investors are also hoping that the home improvement market will pick up again, and Home Depot is one of the best ways to play that. So despite the lackluster results, the stock was up 3% on Tuesday because the company kept its 2025 guidance. Palo Alto. This is the bellwether of the cybersecurity sector. It's a $120 billion market cap company, and June is Palo Alto's fiscal fourth quarter. Company reported very strong numbers, 16% revenue growth, impressive, and 26% adjusted EPS growth, also impressive. It also gave strong guidance for fiscal 2026, and the stock was up almost 5% on Tuesday. Walmart reported a miss to earnings per share for the first time in 3 years due to higher insurance claims and legal charges, which the company expects will moderate. But it did raise its same-store sales guidance, showing that it is still taking market share. And that's the wrap. I'm not going to answer any mailbag today, as I'm saving that for a special mailbag episode where I answer many of your questions. I'm planning on dropping that episode on Labor Day in the early evening. This last week on Monday, I dropped an episode where I interviewed Stephen Tusa, the industrial analyst at JP Morgan. We mostly talked about the impact of AI on the growth trajectory of his sector, a very important topic. And this coming Monday, I'll be posting an episode where I interview Itai Michaeli, the auto analyst at TD Cowen. We spent most of the hour talking all things Tesla. Tesla. Hope you tune in. By the way, another way to access our podcast is to go to our website, realeismanplaybook.com. You'll find all our episodes, the weekly wraps, the long form, and we're going to be adding other things as well. So check it out. And if you haven't already, please consider subscribing to our YouTube channel so you can receive these weekly wraps along with our podcast and the financial literacy masterclasses, which we will be releasing soon. Subscribing is the best way to help the channel, and we greatly appreciate your support. Thanks for tuning in, and see you soon. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.